Let's try to wait for a few more students to join the session, and we can start later on while more students are coming. Hello, Mr. Cheng. Ken Fei. You asked about whether we will have TZ1 tutorial session. Although we have created a Zoom link, but does not mean we will have, because if we finished all the tutorials, I think all the tutorial has already completed, right? Until week 11. So do you have any concern, by the way? Mr. Chen, can you open your mic, please? Because I think TC1 already finished y'all in week 11, right? So which means we do not need, and can I ask whether any other group has not presented the tutorial so far? Just in case, but I remember even our confirmed COVID, we still continue and pursue our presentation tutorial. So I don't think that's delayed, right? Just let me know. Oh, okay, it's okay if your mic has some problem. But to answer your question, by the way, did you complete your TZ1's tutorial topic, by the way? I think, in the past 2 weeks. Mr. Chen, can you reply me by text? Did you finish that? Yeah, of course. I think every group's already, and you're going to submit your tutorial. Only if some of you might have some questions, and then please let me know. Okay, in that case, we just wait a few more minutes and we can start. We can wait while we continue the lectures. By the way, I wonder before we start, any student have some concern about the open book examination? Because I think to be, make sure due to the screen, that it might be difficult to say, like, if we control the online, examination, but without, let you to browse it, it could be quite difficult. So I decided, I think, to change from the closed book to open book. But I'm not quite sure everybody have any questions or problem with that. As I said before, next Monday, if you do not have any concern question, I assume you agree with me, okay? Because I already get approval from program director, so she already approved this application. So let me know, okay? I've asked some student representative if you have any concern. And some students ask about the lecture notes and lecture slides. It will be uploaded after tonight. So all the lectures will notes, but I do not know for the guest lecture for Dr. Jing Zhu whether they have uploaded. But for my part, I already uploaded. There are 2 sections was conducted by Dr. Wang Yang Hu. So if you have some concerns, you can also consult her suggestions or advice. So let me try to share my screen. And this is our final session to talk about the private housing finance mortgage and reverse mortgages. Because since we have already initiated the China dream, right? But the whole dream for Chinese is their house. Whether or not they would going to own their own house. So this is their dream for housing. And I think a long time ago, since ancient period of time, Tu Fu has announced their kind of very poetic, talking about, how would, the housing would become, allocated fairly, whether you are rich or poor, or whatever you have great, sufficient power in terms of or not, you are common people, but you got entitled to a decent living at minimum, which is minimum sectors. And part of the American dream is to own your own homes, comparatively speaking with Chinese dream. But the average price of the house is well over 140,000, which is quite a bit higher in some areas such as California. So for the majority of population, the home ownership would be impossible without borrowing most of the cost of the house. So that is the ownership matters. So you have heard of the 2 women problem, right? But that really an interesting metaphor between the kind of whether you're going to spend the future's money for today's housing or not. And for sources of financing private housing, they have the direct. This is the 4 different channel of the financial contract. The first one is a direct. The second is contractual financing, and then deposit banking, and then the mortgage banking. These are the 4 typical, financial, sectors of that. And if we say there are many multiple sources financing, private housing, directly we say from individuals like personal or commercial property, mostly in developing countries. And second one is for the contracting financing, such as supplementary to the other rules, which is usually from the cooperatives, right? So this contracting financing. And deposit banking, that is generated from the general commercial banks, which is mostly you and me and every individuals then may choose to use such kind of method to do with that for direct source of banking. So which I think to the majority part, people would have such kind of expectation of using direct commercial general deposit banking. And the second one is like if we can tentatively use deposit banking, and that can help you to use, to purchase the house, etc. And then we have the mortgage banking, which means that they could be used from the selling of equity or bonds, and the government would usually get involved. For example, the Hong Kong Mortgage Corporation Limited, but this is mortgage banking. And Chinese people or Chinese home purchaser in China, they have a lot of channels. Like, for example, the financial and property markets in China, they're becoming internationalized. And with more avenues of the housing finance available, more and more people would be expected to rely on the mortgage loan from the newly minted financial institutions in major Chinese cities. By the way, some students still concerned about last year we have the class revision. So next week, we can still hold the kind of class revision, but it will be quite brief because we're going to try to go through this from the beginning chapters to the end chapters. So in that case, we can try to work on such kind of situations for that. So that is quite important, channels for the way how we could, think about what are financial sources for home purchasers. And there are many financing sources for purchasers of commodity housing. And before that, we can try to think about some of the mortgages. What is the mortgage, for example? So if we suppose this is the function of a security, which include both unsecured loans versus secured loans, a security could be linked to a people with property. And the property usually built up a land parcels with personnel assets. So the mortgage is equivalent to one particular form of security over the piece of land, right? So this is the securities that we usually make it quite simple. So one form of security over land. And there are many different loan types all over. So in particularly, one common loan types is a pure discount loan. With the borrower would usually receive, for example, X today, and he or she will agree to pay back another X dollars plus I dollars tomorrow. So this is a pure discount loan. A second type would be the interest-only loan, that we say the borrower would pay interest, periodic interest, for example, in formality of periodic, and then he or she would pay the principal back at the end of the loan. And the third one is amortized loans, which would say the borrowers would periodically payments will be paid, which include interest and principal. So these are the three common loan types that could make it. So the mortgage loan is typically a kind of amortized loan, which is backed by the collateral. So I think some of you might understand what is collateral, right? Which means you're going to use something to back up your mortgage loan, use a piece of housing, for example. So the lender could take control of the collateral if the borrower does not fulfill the contractual obligations. And a lien, which we say is considered as placed on the property. So, sorry, I have to be from time to time to look at when students come in. I'm sorry for that, but some of students might not be quite have arrangement for lectures. I fully understand because everybody got job, right? Everyday daily jobs. So at this time, a lien is placed on the property, which means the lien would prevent the borrower from selling or transferring the property until the loan is paid, right? It's quite easier to understand, right? At first moment, so they would not have such kind of we say, sorry. That's why I always ask to try to wait until more students come in. So, so that the lien is placed on the property, which we would say, if we suppose you are the one of the borrowers, right? You're going to put the lien that you're going to make and prevent the borrower from selling or transferring the property until the loan is paid. And the loans for which the borrower posts collaterals are known as secured loans. Secured loans. And if we put back to the original definition for mortgages, a long-term loan secured by real estate, which is defined by the definitor. And this kind of amortized loan whereby a fixed payment will pay both principal and interest each month. So that is what we call it as mortgages. And mortgages will differ from bonds and stocks. So these mortgages are usually backed up by a specific piece of real property. And the second point is the primary mortgages. They would have no set size or denomination, okay? And the third one is primary mortgages, which generally involve only a single investor. And last but not least is comparatively little information will exist on mortgage borrowers. That's why how we look at mortgages in definition, right? So then we try to use this mortgage loans as specific into the case of practical region, for example, China. And how we look at by using region style, necessity. As we all know, the rising prices would render the home purchaser, and they would render them with the, the home purchasers. Sorry, let me try to get the students in. Because such kind of home purchase would make the rising prices become even more and more difficult, because even they're going to afford the house, but with the rising prices, so the people, the citizens would become out of reach for the rising housing price from day to day. So in this case, the people would lack subsidies or savings. So in order to get access to the mortgage finance for the first time in China, is considered significant to the household in entering the home ownership, which has consequently built the wealth through mortgage payment and home price inflation. This would bring the case of China closer to the situation in the West. That's the necessity. And if we put another angle and possibility, so in the meantime, the Chinese state has endeavored to build a thriving and modern banking system. And they would put strict conditions of borrowing that have limited their effectiveness before the late 1990s. Since then, the state has actually entrusted the newly restricted state commercial banks to extend their mortgage loans. And those commercial banks would compete intensively for the mortgage business because they're considered as very low risk loans. So that's the possibility of the third. If we look at the mortgage, debt, and I mean outstanding in Shanghai, and we can see that that's the choice of the, changes for the mortgage back, the debt. So these are the data from People's Bank of China that show that Shenzhen got 30% and Chongqing got 34% that have the highest percentages of home purchase that is financed by the mortgage loans. But the same data show that the majority of the home purchase will remain financed by the personal savings and the other means to date. So if we try to give to excessive components of mortgages, and that is how we look at the property. Firstly, the physical residence being financed, and the exact form of ownership will vary from country to country and may restrict the types of lending that are possible. So this is a properties, lending, initiators. Second one would be the mortgage, because the security created on the property by the lender, which will usually include certain restrictions on the use or disposal of the property. And for the borrowers, that all the people borrowing who either has or is creating an ownership interest in the property. That's from borrowers. From a lender's perspective, that any lender, but usually a bank or other financial institutions, that means the lender's perspective. For the principal is the original size of the loans. For this situation, we would say that it may not include certain other costs. And any principal would be repaid with the principal go down in size. And for interest, it is quite easy, right? These days, the Americans start to add more interest in their banking system. Interest means a financial charge for use of a lender's money. And the foreclosure or repossession, means the possibility that the lender has to foreclose, repossess, or seize the property under certain circumstances that is essential to a mortgage loans, and that's more foreclosure. And we do have different type of mortgages that would have you look. One is the fixed rate or versus adjusted mortgages. Adjustable mortgages. So the fixed rate loans have a potential kind of constant and unchanging rate. And the interest rate risk could hurt the lender rate of return. But we have two conditions. Firstly, if interest rates rise in the market, a lender's cost of funds would increase. There's never matching increase in fixed rate mortgage return. And for the borrowers who is locking their cost, and you have to refinance to benefit from lower market rates. And for the adjustable rate mortgage, is quite easy, right? Because both of the rates and size of the payments could change. So which make the two different fluctuated rates. Firstly, the maximum allowance, allowable fluctuation over the year and life of loans. And both of the upper and lower boundaries for the rate changes. These are the set. And the lender stabilized professors yields, it could yield much more with the cost of funds. And the certainty for the borrowers whose mortgage payments could change over the time. So that's adjustable rate. And we do have to think about the advantages of fixed rate. And as we all know, the repayments would stay the same regardless of interest rate increases, and which we think it is easier to budget because the repayments do not change. And for the disadvantages of a fixed rate, and we can see that firstly, the repayments do not decrease while the interest rates decrease. And you can't pay off lump sums or increase your monthly repayments. Certainly, if you switch the market to a different rate or to a different provider or repay it early, and you will pay a fixed rate penalty. Right? This is how we look at the fixed rate. So both of the fixed rate and, they may have merits and demerits, right? So pros and cons. But if we look at the adjustable rates, they may also have both advantages and disadvantages. Say, for example, if the repayments would fall, but interest rates fall, okay? And you can also increase your repayments, which means in the meantime, you can pay off your lump sums. And you can apply for the payment break a holiday with a margin that is less on the trigger rate or loan to value. We say LTV rate when your LTV is particularly low. Okay, so that is advantages. For advantageable rate, the demerits is firstly, the repayments might increase when interest rates increase, right? Secondly, is it would be much more difficult to budget for the repayments because of the uncertainties with such kind of rates. So which means this is uncertainties that keep changing. And if we look at the loan to value ratio, that is LTV ratio, that we would say that the size of the loan against the value of the property. And the loan to value ratio would be considered as an important indicator of the riskiness of the mortgage loan. That's LTV ratio, okay? Then the term is quite easier to be comprehensive. The term means the mortgage loans would generally have a maximum term, that is the number of years after which an amortizing loan would be repaid. Some mortgage loans may have no amortization or require the full repayment of any remaining balance at a certain date, So that is a term, okay? And the second very technical question or answer is how to calculate the mortgage. And what is the repayment mortgage? The mortgage loans, if we give a definition, that is firstly the level of payment that is fixed rate mortgages, which means the borrower would pay interest and repays the principal in equal installments over the agreed upon period of time, which is fully amortized over a period of time. This is a level payment fixed rate. If I give you an example that was suppose a 30-year 100,000 loan with 8.125% rate, and their monthly interest rate is 0.0067708. And the interest for month 1 is 677.08. And their monthly payment is 742.5 minus 65.41 dollars. And so this would to reduce the principal, and that is how it look at the example, the 30 years loans. So if we put the contact with a fixed rate mortgage amortization, that we would say the monthly mortgage payment has 2 separate components. And the first one is the payment of interest on the outstanding, mortgage principal. 2 is the pay down or amortization of mortgage principal. And the relative amount of each component change throughout the life of the mortgages. For example, this is a fixed rate. And for the residential mortgage characteristics, we would usually say the fixed monthly payment and repayment would include, firstly, interest earned first, balance to principal as a second. And if we try to calculate the interest on the declining principal balance, and then calculate the monthly payment, that would be firstly, the principal borrowed equals to PV, okay? And the number of months to maturity equals to years multiplied by 12, which is equivalent to N. And the rate, which is divided by 12, equals to I, okay? And then if you calculate the PMT, you can get this number. It's not necessary to really calculate how much it would be, but it would be important to try to give you some mortgage payment accounting for this, okay? If we try to give the payments of mortgage by the rate and time, and that is how it would make the mortgage loan monthly payments in this arena. And that is between the monthly by rate, and easily put into the Excel, okay? So suppose we got a 30-year, $100,000 dollars mortgage loan, which is financed at a fixed interest rate of 8%. And their monthly payment is 100,000 multiplied by 0.8 divided by 12 and divided. So the final, monthly payment would be 733.37, okay? So supposing the first month's interest payment were equivalent to 100,000, which is multiplied by 0.08 divided by 12. And this is 666. Okay, this is first interest payment. And their principal payment is 733 minus 666. That is equal to 67.09. And given this, the new principal is 100,000 minus 67. That is 932.91. So this is in the first month. And in the second month, their interest month payment will be a 99 multiplied. So I think this one is quite easier, right? You just input the every month of the new principal and put this replace and then multiply by 0.08 divided by 12. And then you calculate to the principal payment and new principal with the second month and the third month, and then rolling on. So in this arena, what you're going to try to comprehend is what are the advantages of the repayment? What are the advantages of repayment, right? Firstly, is by the end of the mortgage term, the full amount of the debt has been repaid. As time moves on, the equity percentage in the property would increase. And it would also remove the risk of having an investment, and the performance of which is dependent on the stock market. The borrower is less likely to suffer from negative equity because the mortgage balance will be reducing their month to month. And for disadvantages of the repayment, firstly, in the early years, the bulk of the mortgage repayment consists of the interest component. So not much of the capital is actually paid off for some time. And there seem to be no disadvantages about the repayment mortgage. And the credit constraints of mortgages. We mentioned about LTV, right? LTV ratio. So LTV ratio means the higher the ratio, the higher risk for the banks in housing market. And the payment to income ratio means the higher the ratio, the higher risk of insolvency default. Insolvent default, okay? And then if we keep another market interest rate, that is, the loan will be used for mortgage that has to compete with the other investment opportunities. For example, the interest rate of government bonds. So the risk from investing in mortgages is, what we're going to say is ask, what is rational default? Are there any risk for investing in mortgages? So we have interest rate risk. We have the present value of cash flows, of value of mortgage changes as interest rate changes. So that is how we look at, between A and ring. So that is a rate changes of the issues. So for the longer term fixed rate mortgages financed by the short-term funds, resulting in the risks. In order to make limitation of the exposure interest rate risk, you're going to sell the mortgage shortly after the origination. And but which means we should say, if we sell them shortly, right after origination, the rate would change. That in the short period of time, it would also make the adjustable rate mortgages. Another issue is like, if we try to give the risk from the investing in out, the risk from investing in mortgages, the prepayment, that kind of refinance the prepayment risks. For example, the borrower will refinance if the rates drop by barrel off, paying off the higher rate loans and financing at a new and lower rate. Secondly, the investor will receive the payoff, but has to invest at new and lower interest rate. It will manage the risk with our ARMs or by selling the loans. This is a prepayment risk. And the credit risk could range from default to late payments. And here are the multiple factors that would affect such a default. Firstly, is the level of borrower equity, which we say is LTV ratio, which is often used. And the higher use of that with more defaults. The second one is the borrower's income levels and the borrower credit history. Okay, so this is the three main factors. The third one is the lenders will try to limit exposure to the credit risk. And how to measure the risk? these are the few measurement of risk. Firstly, they would use the sensitivity analysis to reveal various what-if scenarios that cover everything from default to prepayments. The second one is that would incorporate the likelihood of various events, and that would reveal the effect on cash flows. And these institutions would try to measure the risks and use a lot of information to try to restructure or manage such kind of risk or the risk kind of volume, frequency, and occurrence. And also sometimes a degree of consequence of initiating such kind of risk. And for the rational default, firstly, the borrower will find that it is favorable not to pay the debt, even though the borrowers are capable to pay. And secondly, it mostly happen in crash of housing market, for example, negative equity, and it would decrease in property value. Firstly, the down payment plus amount of repaid loan plus the cost of transaction. These are all the decreasing property values. And with longer term, that will bring along a slower in repaying the principal, which increase the risk of default. And a mortgage market, which means a mortgage market would consist of two main components: primary market and secondary market. For this primary mortgage market, they have, we say, the mortgage contract, which be originated between the lender and the borrower, and the money would flow to the lender from deposit first, deposit banking, like usually the banks, commercial banks, right? Second, insurance policy premiums, like insurance companies, and also the pension contributions. And also lastly is secondary market, etc. So I will, maybe we can have a brief break and come back after 10 minutes, perhaps. Let's come back to the lectures. Before we enter into the next page of the discussion, I would like to also similar to send you some interesting introductive and pros for a reverse mortgage, which could be very informative. See whether you can look at this video now.
That idea. That is the subject of this episode. I would not be a true holistic planner if we were to ignore the reverse mortgage. So we need to understand it. You want to understand that all the financial tools have pros and cons, right? They have strengths and weaknesses. And it's not about is one bad and one good. It's about what are the strengths of this financial tool and what are the strengths of this one, and what is the right combination that will produce the most dependable retirement income for you. So a reverse mortgage has to be considered and should be understood. It's not for everyone. Not everyone needs a reverse mortgage. But housing wealth is where a lot of people have most of their wealth, right? It's in the walls of your home in the form of equity. Now, reverse mortgages in the past have had some negative aspects to them, right? And there's some horror stories. But one of the things you need to understand is that the laws have changed, circumstances have changed, and many of the undesirable aspects of a reverse mortgage are no longer there. And so the HECM reverse mortgage has become a very powerful financial tool that may or may not be something that you may want to consider. A lot of times people think that they will have less money to pass on to their children, feeling like having a house paid for free and clear is the most important thing. But if you're short on income, or if you're unsure that your assets are going to last throughout your full retirement, throughout your life and or the life of your spouse, then a reverse mortgage can make a very big difference. And not maybe in the ways that you think. One way would be, if you have a mortgage and you're over 62, it's a way to just basically turn off the mortgage or the payment. You no longer need to make a payment. That all by itself could be a complete game changer. Or if you have a paid off house, it's really just establishing a line of credit that is guaranteed for you to access. Maybe you don't need to use it, but maybe you will. When you understand sequence risk and longevity risk and all the other things that could potentially deplete your assets in retirement, having a reserve in the form of a tax-free line of credit guaranteed by your house can be a very wise thing. Now, there are some misconceptions. And so today, I have a guest here who's I'm going to interview, and we're going to address some of these questions that you may have. So are reverse mortgages a good thing or a bad thing? And that is the subject today. And with me, I have Lynn Williams, who is a mortgage expert who focuses on
this
and
is more
specializes
clear.
in reverse. Lynn, it's good to have you here.
Good to be here. Thank you.
What are some of the misconceptions of reverse mortgages? A lot of times when you say the word reverse mortgage, people, they automatically think it's a terrible thing, a horrible thing. It should be avoided at all costs. Is that true? What are some of the misconceptions?
Unfortunately, there are a number of misconceptions. I run into this quite often when I speak with people, talk with people who are not familiar with the reverse mortgage as a concept. And most typically you hear some of the horror stories that people have been cast out or taken out of their homes, that they've been foreclosed on, that they're giving up the equity to their home to the lender, that the lender is going to take title to the home, that there won't be any proceeds remaining for any of the heirs in the home, that the loan balance could exceed the value of the home and leave them responsible for a deficiency in the loan balance. All of these are misconceptions that have grown over the years, in part as a result of people not staying in compliance with the terms of the mortgage. But more than anything, just a general overall misconception on what the product is and what it isn't, what the terms and conditions are and are not.
So a reverse mortgage is just a mortgage, right? It's a mortgage without a payment.
Correct.
So why do some people fear a reverse mortgage?
People, I find, fear reverse mortgages primarily because they don't truly understand what it is and what it isn't. It is a loan. It's a loan taken out against your home when its primary function is to provide seniors with an alternative means of being able to access equity in their home, which they would otherwise not be able to access without either selling the house or using a more traditional mortgage to do a cash out refinance, or perhaps establish a home equity line of credit. Most people, with respect to selling their homes at that age, most of them prefer not to sell their home. If they've raised their children in their home, if they've been in the neighborhood for an extended period of time, that's where their friends are, that's where their neighbors are, that's where their church is. So all else being equal, most people would prefer to continue to live in their homes for the remainder of their lives.
So a reverse mortgage is a non-recourse loan.
你知道这是什么吗？你相信这个奇怪的小东西在亚马逊上面卖14.4毛8，而且卖出
advertised.
So what exactly does it mean, the fact that it's a non-recourse loan?
A non-recourse loan means that at the point in time when the loan becomes due, the borrowers will not be responsible for any deficiency that might be outstanding on that loan. So for example, the reverse mortgage, one of the features is that you never have to make a mortgage payment. Well, that's because those costs accrue over on the loan balance over time. So that means at whatever future point in time the loan has to be paid off, they look to the property for the repayment, and the property is sold and the balance is due. If there's a deficiency in that amount, then that will be covered by the mortgage insurance that's put on as a result of the FHA guarantees. Significance of that means that neither the homeowner nor their heirs, if they passed away, will be responsible for any loan deficiency.
What are the chances that someone could be forced to move out of their house when they have a reverse mortgage?
Well, that would only happen if they cease to be the primary occupant of the home. One of the requirements of a reverse mortgage is that does have to be your primary residence, and that's determined by a timetable of at least living there for at least 6 months and 1 day out of the year. So theoretically, you could have a summer home at a different location, a winter home as your primary residence, and still be able to enjoy living in that summer home, but you would have to maintain residency in the primary for at least 6 months and 1 day. Unlike a traditional mortgage, you do not have to make a principal and interest payment on the home. However, you do have to continue to make payments and cover the obligations for homeowners insurance, property taxes, and any other association dues.
Which is the same as if your house is paid off.
Exactly.
A lot of times people think that they have to give up the deed to their home. Who owns the house with a reverse mortgage?
Contrary, again, to some of the misunderstandings, the title does not change when you take out a reverse mortgage. The title remains in your name and will include anybody who's been listed as a borrower. Typically, that's going to be a spouse or any other qualified borrower. In the event of your passing, depending on how you set up the estate, then that title would then transfer to your heirs. The reverse mortgage would need to be repaid, and typically it's paid from the proceeds of the sale. In any event, as long as that title is in your name, you have full control over the home. You can remodel, you can sell it, you can do whatever. You have full control over it. But then again, similar to any other mortgage, if you did sell it, that would trigger a repayment provision that would have to be paid. If it were, once it is sold, any excess proceeds over and above the amount required for repaying the loan would then go to the living borrowers, if they're still living, or to their heirs if it's transferred in the estate. Which
is exactly the same as any mortgage, right? There is no difference. it's really kind of a mortgage without payments,
Correct.
right? We can also use money or create a stream of income from a reverse mortgage, right? How does that work?
The proceeds under a reverse mortgage can be taken out in one of or a combination of 4 different ways. The first is a lump sum payment. The second is a payment based on a specific term. So for example, if you only needed to take a draw under the line of credit for a 5-year period at X amount, then it would be set up to calculate out to that point in time. And then at the end of those 5 years, the term would cease. The third option would be to take what we call a tenure payment, TENURE, which is similar in a way to a life annuity, where you that you could take for the remainder of your life, however much longer that might be. And then the fourth way is to just take it on an as needed basis, where you can just request a draw based on specific needs. Any one of those ways can be done, and they can be used in a combination of different ways.
Not everyone can qualify for reverse mortgage. What are the qualifications?
The qualifications are fairly basic. First of all, you have to be at least 62 years of age or older. The home has to be a primary residence, and it has to be an FHA approved residence. And by that, I'm referring to a single family home, also 2 to 4 unit residential property. It can be a condo, as long as it's on the FHA approved list. It could even be a manufactured home, as long as it meets those requirements. And the methodology used to determine how much one can qualify is based off of the borrower's age, the interest rate, and the value of the property. And typically, you would see that range anywhere from 40% on the low end up to maybe 60, 70% on the high end. So in other words, a borrower, if they own a home that's worth $400,000, could typically look at something being able to qualify for an amount in approximately the $150,000, $200,000, $225,000.
So if we use a reverse mortgage, doesn't that mean that our heirs are going to end up with less?
That's a good question. And it really depends on what the borrowers do with the proceeds that are available to them. If they are used strategically, and especially in coordination with a financial planner who understands the product well and can interweave, if you will, the things that the reverse mortgage, the flexibility that offers with their overall financial plan, what it can actually end up doing is making their financial plan more efficient in a number of different ways, which would mean that while there may be less equity for those heirs remaining in the home at whatever future point in time the home becomes theirs or is transferred to them, they could end up having a significantly larger amount available to them in actual cash assets through the remainder in their estate through the retirement planning. So we actually see it as a more advantageous way for legacy planning for your heirs, because most children, in spite of what parents might think, the children have always wanted to own this home. We've always wanted to give it. The kids want the house. 0.5% of children who inherit their homes ever end up moving into the home. Normally, the first phone call that they make after the funeral is to a realtor finding out how soon they can list the house. So much better and much more effective to be in a position to leave them cash rather than to leave them with an asset like a home that now they have to figure out how they're going to get it ready to sell.
As I do, holistic retirement planning, there are all kinds of strategies that that we use with a reverse mortgage for those who it makes sense for, right? It doesn't make sense for everybody. Not everybody needs it. But a reverse mortgage can act as a volatility buffer. So if you have a line of credit on your home that you could access guaranteed at any time, when the market is down, rather than taking assets for withdrawing for income, in those scenarios, if you take money out of the house for that year, you're able to create a volatility buffer. and it sustains a retirement account in a very impressive fashion. And so there really are new ideas and new strategies all around holistic retirement planning, and reverse mortgage is a tool that can make a big difference for a lot of people. So Lynn, I want to thank you for taking your time. I look forward to seeing you in the next episode.
I think there's still a few more, but you can try to get back to this. But I think the pros and cons for this kind of reverse mortgages is very clearly indicating this in this PPT, the videos. I think I myself really appreciate a lot and read these videos while I have some time. Now let's get back to the mortgage markets. The two, we have mentioned the two, primary and secondary, and then the mortgage borrowers and the first primary we have introduced. And for the secondary mortgage market, it is we would say the firms known as conducers may assist with the sale of the lender's mortgage, and the mortgages could be transformed from a pool of mortgages into a mortgage-backed security and sold to multiple investors. So in which context do you think you could get a loan to purchase a house? In the video they have shared, a lot of such kind of purchasing. But we do have some kind of hints or some points for you to pick up. Like first and foremost, the primary mortgage market. Like in the traditional loan, the local commercial bank could lend money to an individual to buy a house by using the fund deposit with that bank. And the credit or default risk is entirely borne by the local bank. The main advantage of this arrangement is that there is little moral hazard, because the local bank has very strong incentives not to make the loan, in a bad, trend. The back loans would not be met. So that kind of arrangement has three disadvantages. The first one is small or growing markets may not have enough liquidity. And the second point is the borrowing could shut down if the local banks are in trouble. Third point is local banks hold an undiversified portfolio and are exposed to the risks that could be diversified. So these are the three, disadvantages arrangement in the primary mortgage market, right? But they also have to think about some problems in terms of primary housing mortgages. Like first one is maturity transformation, which means a small reserve for short-term withdrawal and a large number of small depositors. The second one is asymmetric information, which means they can and give different access to relevant information. First one is moral hazard, like we say the principal as the employer and agent, employee relationships, and some hidden action concealed by the agent. And the principal cannot fully monitor the agent's behaviors. B is adverse selection. We say the seller and buyer relationships and hidden characteristics, which is concealed by the seller and the buyer. They could attract the sellers unconditionally. So this is symmetric as information. These are the information. In last lecture, we introduced the mortgage securitization and also the bubbles, in terms of the housing financial risk. But subprime mortgages is originality of that triggering that boundary point. So we have last lecture we mentioned about Freddie Mae and Fannie Mae, Fannie Mae and Freddie. So the United Congress have created Fannie Mae in 1938 to keep the mortgage market liquid. At the original point, Fannie Mae only bought mortgages issued by Veterans Administration and the Federal Housing Administration. So the Congress have created the Federal MAC in 1970s to buy the mortgages under the Federal Home Loan Bank Board. By purchasing such kind of mortgages from these institutions, Fannie Mae and Freddie Mac would make easier for them to provide additional funds. So commercial banks, as well as the other financial institutions, would offer mortgages in the primary market through selling the mortgage to Freddie Mac and Fannie Mae. And Freddie Mac and Fannie Mae would package those loans somehow. So to another circumstances, the Fannie Mae has lending guidelines for what it considers to be prime borrowers and conforming the mortgage loans with the loans that they buy or securitize into the credit market. The second one is a prime loans would have a credit score above 620 with a credit score such as between 350 and 850 with a median in the US of 678, as well as a mean of 723. This is no more than 55% of net income pays for the housing and the other debt, and the borrower would pay a 10% down payment. So in this arena, we would try to give a quick, just like the cartoon shows. The subprime lending is risky for both lenders and borrowers due to the combination of higher interest rates and the poor credit histories and potentially adverse financial situations that are sometimes associated with subprime applicants. So in this, after defining the subprime mortgages in terms of the word meaning, we do have different kinds of subprime mortgages. Firstly is interest-only mortgages, which allow borrowers to pay only interest, that may be interest only for the period of time. In particular, we would say only 5 to 10 years time, interest-only mortgages. Two is pick a payment loans, for which the borrowers would choose their monthly payment, like the full payment, interest-only payment, or the minimum payment, which may be lower than the payment that is required to reduce the balance of the loans. The type C is initial fixed rate mortgages that quickly convert to variable rates, like 2 to 28 loan, with a low initial interest rate that stays fixed for 2 years, after which the loan resets to a higher adjustable rate, as we say, adjustable rate and fixed rate. And for the remaining life of the loans, in this case, will be, we say, 28 years to some circumstances. And the subprime mortgages, we would say is quite different from the secondary mortgage market. Somehow we're going to really compare the three definitions and make crystal clear what's the differences, right? The secondary mortgage market is considered as a market for the sale of securities or bonds collateralized by the value of mortgage loans. And the subprime mortgage market is included as the primary mortgage and secondary mortgage markets, which related to the mortgages with higher risks on the repayment. And the refinance is about the refinance of the housing or self for the second time in the primary market. And then we have mentioned the reverse market, right, in the videos. But as a standard mortgage lenders, this already been introduced in the video. But I want to just give some hints. Firstly, the lenders would provide lump sum money. The borrower would use this lump sum to purchase a home, right? And the borrower would make monthly loan payments to lenders. In this reverse mortgage due, the borrower would provide home equity, right? So similar is the case. And the lender uses home equity to back a loan. And the borrower will receive the monthly reverse loan payments from lenders. And the borrower would qualify for the majority reverse mortgages if they are 62 years old. For example, they are in Hong Kong 60 years old, and they live at their homes. And the loan would become due if the borrowers, for part one, the borrower die, okay? If the borrowers sell their home, if the borrowers will move to another principal residence. This is first one. And the borrow with amount of money in the reverse mortgage will depend on three. First, the age, right? Type and appraised value and location of the homes. Generally speaking, more could be borrowed if the elder, which means they may have a high risk of finishing, completing the project, and the more valuable the home. And lastly is the last that is owned on the home. And third one is the proceeds from reverse mortgage are typically tax-free. And those reverse mortgages appeal to the house rich but cash poor homeowners for those one. And for those home reverse mortgages would want to stay in their homes. And the reverse mortgages would dues, this kind of dues, but sometimes highly complicated. And there are a lot of potential borrowers that should fulfill and fully understand all the details of the deal. There are some advantages and disadvantages. For the advantages, that would provide a lump sum of tax-free cash or a steady income, like the annuity for the rest of your life, for example. And that would reduce the amount of inheritance past paid by your from your estate. For the disadvantages, like they can decrease the amount of money with your family that would inherit it upon after the death, and assuming that the value of the property would grow at a slower pace than the interest rate on the mortgages. Two is that would reduce the amount that can bequeath to the charity. And that would also impact any means that tested benefit that the borrower may be entitled to, right? So this is how the entitled housing. But someone will ask about the term or straight reverse mortgages. Firstly, the lender is limited to receiving the value of the house. And this will become appropriate for people who only need money for a short period of time, and the amount owing will seem to grow quite quickly because it is accumulating without any repayments. Here's an example for you. Suppose the home is worth 150,000 and the owner gets a 5-year term reverse mortgage, and this have received a lump sum payment of $50,000. Interest would be built upon that particular money for a maximum of 5 years. And at which time the entire amount would be paid back, And another in terms of issues that is quite important is it generally provide a life annuity to the owner. At death or when the house is sold, the mortgage must be settled. And the estate or retire will receive the difference between the value of the house and the mortgages. This is a reverse annuity mortgage. And the lender cannot recover more than the value of the house. And this is best for people who want security of the monthly income for the rest of their lives. This is another example. Suppose the home, is worth 200,000. And the homeowner would take out a reverse mortgage for $50,000, and that $50,000 used to buy an annuity which pays out 300 a month. And in 10 years' time, the total, we should say, the house will be sold, and the $50,000 plus interest will be paid back. And that 300 monthly income from the university, we should say that the house would become, continuous when the homeowner still, the rest and continues. So I want to try to, finish today for the lecture, see whether you have any questions so far. And some students may concern about the, the something like your online examinations. So next week we can, after we finish the revision, give some briefing about all from lecture 1 to the end, except for the guest lectures. And we're going to try to give a trial. So try to make your best time and effort to attend the last lecture revision, because we're going to have some tests for online. But they won't have any questions, but just to show you how to do that. Okay, so any questions so far? We can leave around 5 times for you to give me some feedbacks, perhaps. Any questions? If you have questions, you can write in the text. No need. Try, if you feel you don't want to talk, you just write in the text. I can answer your questions. 王老师，这是我们大学今天的新闻。这个呢，你可以发给这个大学的你们这边的什么一些人，让他们不要相信这些流言。然后我觉得，如果这个流言还是他们愿意去相信的话，我们就是只能以法律的手段对他们了。I think we can finish today's lesson because nobody gonna to ask. I just received the that I think assume nobody would answer my questions and ask any questions. Before we finish, can I ask you try to raise your concerns or about the online examination, and also see whether you have any issues related to the online exam. We firstly will announce this in the Canvas system. Secondly, we're going to try to give you some potential, signals of the issues. One more issue is a kind of online teaching and learning questionnaire. Our head department asked whether you got any, time to complete into that. So do let me know if you have any time to complete the TLQ, because this is quite important for every lecture. Do you really have questions? Because keep waiting. No more questions, and that's all for today's session, because we don't now have any tutorial tonight, right? So just to make sure everything is on your kind of side. See whether, I hope maybe COVID-19 will finish and we can continue the normal. And this is very tough year for us. Thank you so much. See you next week. Try to present next week because I'm gonna to have a briefing review from the lecture 1 to the end. Okay, thank you so much. Good night and bye-bye. Thank you.